Today, we're going to look at performance evaluations for decentralized operations. This is a very short chapter, as you've probably noticed. So, in a generalized centralized company, you're looking at all of the major planning, the operating decisions, everything is made by top management. You're looking at CEOs, very high up. However, in a decentralized company, managers in different divisions or units are going to have delegated operating responsibility, meaning that they're going to be held accountable for certain things. Those division or unit managers are the individuals that are actually responsible for planning and controlling the operations of their divisions. This makes sense because they're the ones who are controlling the goods that come in, they're the ones in touch with the employees. So, structuring around products, customers, or regions allows for a more intimate knowledge of operations. Some of the advantages of it for large companies, it is very difficult for top management to really have daily contact with all levels of operations. Everything from the mailroom up, they just can't do it. There's too much going on. It's also nearly impossible for them to have an operating expertise level in every product, service, and procedure in an entire organization. So, by delegating the authority to managers that are the closest to those operations, you can get really better decisions that are more practical and realizable. Decentralized operations provide excellent training grounds for managers. They can work in one particular stream all the way from the beginning up to the top. Then they can learn to cross over to another product. It's a really great model. Delegating that responsibility allows those managers to develop managerial experience earlier in their careers. You'll find as you go out into the workforce, sometimes it's difficult to get managerial or supervisory experience that is really applicable and usable for your resume. By creating decentralized operations and these management at a lower level with authority and responsibility, companies can help retain their managers longer. People can move up through an organization and then maybe eventually actually be promoted to top management because they will have gained their managerial experience necessary for those top management positions. The managers in decentralized operations, remember this is like at a product or a service level, are the ones that work more closely with the consumer. So they're going to identify with their consumers and they're going to be really creative when it comes to suggesting operating or product improvements, procedures, and these other factors from the consumer point of view. Having an answer ready as soon as we see a problem from the consumer point of view helps to create great customer relations. And business is nothing without their customers. However, there are some disadvantages to decentralization. Some of this is that decisions that are made by one manager can actually negatively affect the entire profits of the company. Another disadvantage of decentralized operations is that the assets and the expenses can end up being duplicated across divisions because different managers are making different decisions that are highly similar, and you will lose some of your economies of scales in this situation. Just take a minute and go ahead and read this slide that discusses the advantages and disadvantages of decentralized operations. Just it just bullet points them out for you. In decentralized business, accounting is going to assist each of the managers in evaluating and controlling their areas of responsibility, which are called responsibility centers. Therefore, responsibility accounting is the process of measuring and reporting operating data by specific responsibility centers. There are three types of responsibility centers. There are cost centers, which have responsibilities over costs. There are profit centers, which have responsibilities over both revenues and costs. And then there's investment centers, which have responsibility over revenues, costs, and investments in assets. Cost center managers have the responsibility for controlling costs. However, they don't make decisions that are related to sales or the amount of fixed assets that are invested in the center. They can vary in size from a small department to an entire manufacturing plant. Cost centers may exist within other cost centers. So you have one large cost center with subset cost centers within it. So let's look at the cost centers in a university. The College of Business uh, is itself a cost center. It has within it the Department of Marketing, the Department of Accounting, and the Department of Management. And then the Department of Accounting is its own cost center. When we look at this and we think about this, so at the college level, when we're looking at the College of Business versus the College of Engineering versus the College of Arts and Sciences, the individual colleges themselves are not revenue generating. They're not receiving revenues. The university itself is, but the college is not. When we break it down into those three different cost centers, we then have the additional subsets within them for the various departments. They're all going to experience costs, things along the lines of possibly technology costs, such as software, hardware costs, such as computers, or, the greatest cost that is associated with any university, which is the salaries and wages associated with the professors. Responsibility accounting for these types of cost centers focuses on controlling and reporting of costs only. The budget performance reports that report budgeted and actual costs are normally prepared for each cost center. And we talked a little bit about the budget to actual and how that was done on an entire organization level. So here you would just break out the section that belongs to a cost center, and that is what you would report. As you can see here, this is how, for a cost center, there might be some different reporting levels. So the supervisor for Department 1 may receive information that is applicable only to them, or the supervisor for Department 2 would receive the information applicable only to them, and the same for Department 3's supervisor. Now, all of the information for Department 1, Department 2, and Department 3 are going to roll up and be a part of the Plant A cost center information, which that manager will receive. And all of Plant A's information will then also roll up into the Production Department's cost center, which is given to the Vice President of Production. Here we have three different managers responsible at three different levels, monitoring and controlling costs that are within their realm. Here's a quick glance at how those reports would actually break down, how the information would roll up from Department 1. And there in that middle report, the budget performance report for the manager at Plan A, you'll notice that they have it broken down between administration, which would be those things that are not related to the various departments. Then they show Department 1, 2, and 3's information. And then how all of that rolls up globally to Plant A for the Vice President's production report. Now, nuclear power companies' costs were over budgeted by $24,000. The company is divided into North and South regions. The North region's costs were under by 2. We need to determine the amount that the South region's costs were over or under budget. So we know that the total over budget was 24,000. So that is A in this particular problem. However, all of the under budget for the North region, the full 2,000 was consumed. So we add $2,000 to it to determine we were globally for the South region over budget by $26,000. Profit centers. These are areas that have both revenues and costs attached to them. And the manager has a responsibility and the authority for making decisions that affect both those revenues and costs. They can be divided into divisions, departments, or products, whatever is most applicable for that company. The manager does not make any of the decisions about the fixed assets that are invested in that center. However, they do make it in regards to other costs. When we're talking about responsibility accounting for these types of centers, profit centers, we're going to find there's a focus on both reporting of the revenues and the expenses, and then, of course, eventually the bottom line income from operations. So, responsibility accounting for these is going to take the form of an income statement. However, it's going to be an income statement only for that responsibility center. The profit center income statement would include only revenues and expenses that are controlled by the manager who is receiving it. Controllable revenues are those that are earned by that profit center, and controllable expenses are those costs that can be influenced or controlled by the decisions of the profit center managers only. So, this control element really comes into play now. The controllable expenses of those profit centers would include direct operating expenses. Remember, those are the things we can actually trace directly to something. This would be sales, salaries, even utility expenses. Also, they may have other expenses from internal centralized service departments, such as research and development, legal, telecommunications, information and computer systems, facilities management, purchasing, advertising, payroll accounting, transportation, or human resources. Service department charges. So we're looking at all these various ones I just named off, from research department all the way down to human resources. Are indirect expenses to the profit center. They're allocated there. They're similar to expenses that would be incurred if the profit center purchased those same services from outside the company. A profit service manager has control over service department expenses if they are free to choose. Now, that's the key words, free to choose how much of the service is going to be used. In those instances, the service department charges are allocated to the profit center based on the usage of the service by each profit center. There's that control aspect, free to choose. We have Nova Entertainment Group here. They're a diversified entertainment company that has 2 operating divisions organized as profit centers. So since they're profit centers, they will have both revenues and costs in which we need to determine. There's the theme park division and the movie production division. The revenues and direct operating expenses for the 2 divisions are indicated here. 6 million in revenues for the theme park, 2.5 million for movie production. There are operating expenses of $2,495,000 for the theme park and $405,000 for the movie production division. Operating expenses consist of direct expenses. This is the wages and salaries of the division's actual employees. Now they have a variety of other service departments that they have to support and fund. And the expenses that were incurred by those are listed here for purchasing, payroll accounting, and legal, totaling $905,000. An activity base for each service department is used to charge service department expenses to the theme park and the movie production divisions. The activity base for each service department is a measure of the services that were performed. So for NEG, the service department activity bases for purchasing are number of purchase requisitions. For payroll, number of payroll checks. And for legal, the number of billed hours. So they're breaking it apart by division based on these specific activity bases. The use for the two divisions, these profit centers, breaks down as indicated here. I'll give you just a second to give this a quick look. Now, do you notice on here that we're not looking at dollars yet? We're only looking at the actual activity basis. So we have to determine the rate at which each of these services is going to be charged to the division. The rates are computed by taking that service department expense and dividing it by the total usage. So there were 40,000 purchase requisitions. We take that and divide that into the 400,000 that was from the purchasing service department. So we will allocate it $10 per purchase requisition. We carry this through based off total and total service department usage for both payroll and legal as well. The services that are used by each division are then multiplied by the service department charge rates to determine the service charges for each of those divisions. This is the basic equation. So carrying that back through, you see here in notes A, B, and C how we allocate the purchasing, the payroll, and the legal between the theme park and the movie production. They are done by taking how many requisitions or payroll checks or hours each department consumed and multiplying that by the rate per activity. We then can allocate this on the actual usage. So here we have the centralized legal department at Johnson Company with expenses of $600,000. The department has provided a total of 2,000 hours of service for the period. The East Division has used 500 hours of legal service during the period, and the West Division has used 1,500 hours. How much should each division be charged for legal services? Now, the entire expense was $600,000. So we need to divide $600,000 by the total, the activity base being hours of 2,000. We then take that amount, the 600,000 divided by 2,000, which is $300 per hour, and we multiply that by the number of hours billed into each division. That gives us 150,000 for the East, 450,000 for the West. So this divisional income statement wouldn't necessarily be given to managers in both divisions. This would be one more step up. We'd be seeing the breakdown between the two. This is regularly done in areas that have multiple divisions or multiple departments, and they want to see how this is going to play out. Who is actually yielding greater income from operations. They can then calculate any of the specific ratios based off just the department. Sometimes when you look at it, so it's 3 million income from operations. That's obviously higher than 1.6 million. However, isn't necessarily the highest return on revenues. It could not be, or it could be. It allows managers to make more informed decisions looking at it when it is aggregated and segregated in this way. When those profit center managers are comparing things like this, um, income from operations is going to be compared over time to a specific budget. However, it should be compared across profit centers because the profit centers are usually different in size, products, and customers. As we saw in the previous slide, there is some pretty significant difference in the income generated. So their markets, their demographics, who they're serving are different. So you don't want to apples them and just say one made 3 million, one made just over 1, so the 3 million one must be better. You want to take all factors into consideration if you are doing a comparison between profit centers. Now we're going to use this data from Johnson Company and to determine the divisional income from operations for the East and West divisions. The internal service charge for the legal department was $150,000 for the East and $450,000 for the West. So we have sales of 3 million, cost of goods sold of 1.65, and selling expenses of 850 for the East Division. So give me just 1 minute. We take the 3 million, we reduce that by cost of goods sold. We then reduce that by the selling expenses. And then for the East Division, they had 150,000 in legal. So we're looking at 350,000 in income from operations for the East, 1.5 million from the West. Now, the last type of center is the investment center. They have responsibility and authority to make decisions that affect not only the costs and revenues, but also the assets that are invested to be used in that specific center. The investment centers are often used in diversified companies by divisions. In these cases, divisional managers are going to have the authority similar to that of a chief operating officer or a president of a company, but only in relation to their specific division. Because investment center managers have responsibility for both revenues and expenses, income from operations is a part of their reporting. They also have responsibility for those assets that are invested in the center. So there's two other measures of performance that are used. We have the rate of return on investment and then residual income. Here we show you the North, the Central, and the Southern division. As you can see here, we have the basic format for the income statement showing operating expenses, income from operations before service charges, the service department charges that are applicable to each division, and then the income from operations for each. This is the divisional income statement. This is what an investment center manager would be looking at. Now, because they control the amount of assets that are used in those three centers, they need to be evaluated on the use of those assets. Is it efficient? Is it effective? One of the key measures for this considers the assets invested in an investment center, and that is the rate of return on investment or the rate of return on assets. This is a basic ratio, and it is income from operations divided by the invested assets. The rate of return is useful because there are three factors subject to control by those division managers: revenues, expenses, and invested assets. So think about that: revenues, expenses, and invested assets. Revenues less expenses equals income from operations. Then divide that by invested assets. All three elements that are controllable by an investment center manager are represented in the rate of return on investment measure. The higher the rate of return on investment, the better the division is using its assets to generate income. Therefore, the rate of return on investment measures the income for each dollar that has been invested in assets in that specific center. This results in the rate of return on investments being used as a common basis for comparing divisions with each other. We've been given the amount of invested assets in data link for the three divisions of the Northern, Central, and Southern Division. Because remember, in this situation, in this investment center, we're looking at all three divisions as being a part of it. So using the income from operations for each division, that was several slides back, the rate of return on investment for each of them is computed here. For the North Division, we're looking at 20%, the Central Division 12, and the Southern Division 15. At a quick glance, we're going to say the Northern Division is by far operating much better than the Central and Southern Division. As an investment center manager, your next determination would be why. Why is it operating so much better? Is this duplicatable? Is it replicable? Can I somehow translate what is being done in the Northern Division into the other divisions to increase their rate of return on investment? Another one of the ways that we can analyze the difference in the rate of investment across divisions is called the DuPont formula. This is the rate of return on investment turned on its ear a little bit. It views the rate of return on investment as a product of two factors. There's the profit margin, which is the ratio of income from operations to sales, and the investment turnover, which is the ratio of sales to invested assets. So here we have the basic DuPont formula. The rate of return on investment equals profit margin times investment turnover. Profit margin being income from operations divided by sales, and investment turnover being sales divided by investment assets. This is also useful when evaluating divisions against each other because the profit margin and the investment turnover reflect the underlying operating relationships of each division. The profit margin is going to indicate operating profitability by computing the rate of profit earned on each sales dollar. If a division's profit margin increases and all other factors remain the same, their rate of return on investment will increase. The investment turnover indicates operating efficiency by computing the number of sales dollars generated by each dollar of invested assets. If the investment turnover increases, and again, all other factors remain the same, the division's rate of return on investment will increase. So we can look at it from, just like I said, a little bit of a skewed way, but this is actually a very preferred formula. So using this formula for the three divisions, we yield 20% for the Northern Division, 12% for the Central, and 15% for the Southern. To increase the rate of return on investment, the profit margin and investment turnover for a division need to be looked at each individually. So let's look at the revenues of the Northern Division. Let's assume they could be increased by $56,000 through increasing operating expenses such as advertising to $385,000. The rate of return on the investment for the Northern Division using the DuPont formula can then be recomputed, and it would be 22%. The rate of return on investment is also a deciding factor on where to invest additional assets to expand operations. So, still using data link, we want to know if they should give priority to expanding operations in the Northern Division because it earns the highest rate of return on investment. So, if an investment in the Northern Division will return 20 cents on each dollar invested, in contrast, investments in the Central and Southern Divisions will earn only 12 and 15 respectively. However, for everything, there's going to be some disadvantages. A disadvantage to this rate of return on investment as a performance measure is that it can lead divisional managers to reject new investments that could be profitable to the company as a whole because they are hyper focused, only looking at a small portion of the pie. They don't have the 5,000-foot view. So here are the following rates of return for the Northern Division of DataLink. We have the current rate of return on investment, the minimal acceptable rate of return on investment set by top management, and the expected rate of return on investment for new products. If the manager in the Northern Division invests in the new project, the Northern Division's overall rate of return will decrease from 20% because of averaging. So the division manager might decide to reject the project, even though the new project's expanded rate of return of 14% exceeds the minimum acceptable rate of return of 10%. So because they are focused on they're at 20%. They want to see something at 20 or break 20 for their division. They're rejecting something that is within acceptable parameters by the minimum acceptable rate of return. We'll go ahead and skip the Campbell Company exercise. Feel free to come back and calculate this out for yourself using the DuPont formula to calculate the rate of return on investment. Now remember, that's the profit margin and the investment turnover. The other factor in investment centers is residual income. This is useful in overcoming some of the other advantages of the rate of return on investment, the other disadvantages of rate of return on investment. Residual income is the excess of income from operations over a minimal acceptable income from operations. So the organization sets a minimal acceptable income from operations, and it's computed by multiplying the company minimum rate of return by the invested assets. The minimum rate is set by top management, and it's going to be based on a variety of factors such as cost of financing. That is looking at if we use bonds, we use stocks, we use notes payables, mortgage payables, what type of financing measures do we normally use, what is our makeup, and that is how they start to come up with that minimum rate. So here's the basic representation for residual income. You start with income from operations. Now remember, this is going to only be based on the investment centers. Less the minimum acceptable income from operations as a percentage of invested assets. And then that's going to utilize for is what our residual income is for this investment center. When we use this specific measure, the residual income measure for the Northern, Central, and Southern divisions, which are all a part of this investment center, we find that the Northern division has $35,000 of residual income. The Southern division has $25,000 and the Central division 14. Now, what's the key difference in them that is causing this to happen? We'll continue to look at residual income and we'll show you how to break that apart. The major advantage of it is as a performance measure, it considers both the minimal acceptable rate of return, the amount of assets that are invested, and the income from operations for each division. In doing so, residual income encourages the division managers to maximize income from operations in excess of the minimum. This provides the incentive to accept any project that is expected to have a rate of return in excess of the minimum. So let's look at these rates for the Northern Division. Their current rate of return on investment is 20%. They have a minimal acceptable rate of return on investment set by top management of 10. There's an expected rate of return on investment for this new project of 14. If the manager of the Northern Division is evaluating the new projects using only the return on investment, they might decide to reject this product because it will decrease their overall current rate of return of 20%. However, if they're evaluating it using residual income, the new project would likely be accepted. This is because investing in the new project will increase the Northern Division's residual income. So, in this way, residual income supports both the divisional objective and the global overall company objectives as well. One of the problems you may find out in the real world is that sometimes bonus structures that are in place for divisional managers may actually be a little contrary to encouraging using something like residual income, where if you're exceeding the 10%, if it is set for something higher as far as in ROI, in order to trigger the bonus, then it is not in that manager's favor to allow their overall ROI to diminish by accepting something that only has a 14% return on investment. These are the kind of things that are actually at play in the real world that you will see at some point in time. So we have the wholesale division of Peanut Co. They have income from operations of 87,000 and assets of 240,000. The minimal acceptable rate of return on assets is 12%. So income from operations of 87,000 less the minimal acceptable income from operations as a percent of assets, so 240,000 times 12%, provides residual income of 58,200. We're starting to introduce you to the Balanced Scorecard. You'll actually learn much more about this particular measure later on in your academic careers. But what it is a set of multiple performance measures for a company. In addition to financial performance, which we have spent, a semester and a half, a semester and 3/4 beating into financial ratios, net income, profit margin, contribution margin, all of these different things that are financial. The balanced scorecard goes outside of that as well. They use financial measures, but they also look at things like customer service, innovation and learning, and the internal processes of the organization. All of these become a global measure for a department, for a division, for an organization, the company as a whole, because they are applicable factors in the efficient and correct operations of an organization. It attempts to identify those underlying non financial drivers or causes of financial performance related to innovation and learning, customer service, and internal processes. All of these are actually different things that contribute to your financial performance. And by identifying them and measuring them and ensuring that they are at a threshold that you expect, then you can continue to support and possibly improve your financial performance in periods to come. So these are not set in stone. These are just to give you a little bit of an idea of how those different ones work. So, for maybe innovation and learning, you want to look at the number of new products or new patents, maybe your number of cross trained employees, how many training hours you have, if there's ethics violations, and what your employee turnover is. For customer service, you're going to want to look at how many times do you have repeat customers? What is your customer brand recognition? Delivery time to your customers, customer satisfaction, the number of sales returns, and customer complaints. For internal processes, you might want to look at how much waste and scrap is there, what is the time to manufacture the products, how many defects were there, how many numbers were there in rejected sales orders, how many times did we stock out, what is our labor utilization. And then financial, of course, we've got the typical ones: sales, income from operations, return on investment, profit margin, and investment turnover, which will give you the DuPont. Residual income, actual versus budgeted, standard costs. Now, a lot of times when you have different products or different services, different divisions, sometimes they need to move something from one division to another. When that happens, we will use a transfer price to move that, because transfer prices do affect a division's financial performance. Setting the transfer price is very important, and it is a sensitive matter. And it is for both the selling and the buying division. There are three approaches that can be used: there's the market price approach, the negotiated price approach, and the cost approach. The objective of setting this transfer price is to motivate the managers to behave in a manner that will increase overall company income. So if Division A has an item that you need, that it is in their favor to provide it to you. However, uh, we don't know what that specific price would be at this time. Management has to make that time. So management can set those transfer prices as low as the variable cost per unit, or it can be as high as the market price. Most of the times, it's going to be at some point in between. So that way, each division actually generates revenue from the use of the transferred item. So here's a basic income statement with no transfers between their divisions. You see how many units, how much per unit in sales and variable, the fixed allocated expenses for each division, and the income from operations. If we wanted to use the market price approach, the transfer price is going to be the price at which either the product or the service would be sold to outside buyers. If an outside market exists for this, the current market price is absolutely allowed to be used as a transfer price. So here we're assuming that all materials used by Wilson in producing snack food in the Western Division were currently purchased from an outside supplier at $20 per unit. The same materials are actually produced by our Eastern Division. They are operating at full capacity, and they can sell all of the products that it produces to either the Western Division or to outside buyers. This makes the Western Division an equally competitive buyer to all the other outside buyers. So the transfer price of $20 per unit has no effect on the Eastern Division's income or total company income. They will earn revenues of $20 per unit on all of its productions and sales, regardless of who pays it. The Western Division will pay $20 per unit for those materials from the Eastern Division. In this situation, the use of the market price as the transfer price is proper. However, if there is unused or excess capacity in the supplying division, in this case, that's the Eastern Division, and the transfer price is equal to the market price, total company profit may not be maximized. This is because the manager of the Western Division will be indifferent toward purchasing materials from Eastern or from the outside suppliers. It makes no difference to him which one he purchases from. So, in both cases, the Western Division manager is going to pay $20 per unit, whether it is from the Eastern Division or it is from their outside vendor. So the Western Division may purchase their materials from outside suppliers. However, if they were to purchase them from the Eastern Division, the difference between the market price of $20 and the variable costs of the Eastern Division of $10 per unit can cover fixed costs and contribute to overall company profits. So the Western Division manager should be encouraged to purchase the materials from the Eastern Division. This approach is going to allow the managers to agree between themselves on a transfer price. The constraint is that the transfer price be less than market, but greater than the supplying division's variable costs per unit. It will sit somewhere in between. So let's assume that instead of a capacity of 50,000 units, their capacity is 70,000 units in the Eastern Division. Let's also assume that they can continue to sell only 50,000 units to outside buyers. However, they can manufacture an additional 20,000 units. A transfer price of less than 20 would encourage the manager of the Western Division to purchase from the Eastern Division. This is because they're currently purchasing their materials from outside suppliers at the cost of 20. So its overall materials costs would decrease and its income from operations would increase. Also, if we were to engage in this particular approach, the transfer price above the Eastern Division's variable cost per unit of $10 would encourage the Eastern Division to supply materials to the Western Division because they would have an increase in income from operations. Would not be on par with a market price, but they would still increase their income from operations. So in one division, we will decrease costs, and in the other, we will increase income. So overall, we are doing a positive thing for the company on a global scale. So here is the income statement with negotiated transfer prices in it. Any negotiated transfer price between 10 and 20 is considered acceptable, as shown here, because they have a $10 variable cost per unit, a $20 market price. Each division manager will actually have an incentive to negotiate the transfer of those materials, and the overall company's income from operations is going to increase. However, this is only if the supplying division has adequate excess capacity to feed the division that needs the materials. We will actually go right through this specific example, and feel free to come back and visit the Winston-Salem division of Fox Company. The third approach is the cost price approach. This is when cost is used to set the transfer prices. Now, there's some variety of costs that can be used. This could be the total product cost per unit. This is direct materials, direct labor, and factory overhead. Or this can just be the variable product cost per unit, which is your fixed factory overhead excluded from the transfer price. You could use actual costs or standard costs for the cost approach. If actual costs are used, the inefficiencies of the purchasing division are then transferred to the purchasing division. So there's not a whole lot of incentive for the producing division to control costs. Um, Most companies really will use those standard costs that we've actually talked about a couple of weeks ago in the cost price approach. In this particular way, differences between actual and standards remain with the producing or supplying division for cost control purposes. The cost price approach is often used when this responsibilities are organized as cost centers. Now recall to earlier in this particular lecture, cost centers only deal with expenses. We have gone through chapter 23. As I said, it is a very short chapter. There is not a ton to it. Your next chapter will be chapter 24, and that will be available and up here shortly, talking about differential analysis and product pricing.